Okay, let's have a look at this simple consolidated statement of financial position. We have a 100% subsidiary given to us in the question here, 100% ownership of the subsidiary by the parent. And we can see here in the parent's balance sheet that there's an investment in the subsidiary of 20,000, and that's equal to the subsidiary's equity there. 20,000 is the total of their equity shares, $1 apiece, and 10,000 in retained earnings, total of 20. So their total equity is 20,000, and that's what the parent would have to pay to acquire 100% of the business. So those two are related. And to consolidate, well, we need to show the two companies as if they were one. So first of all, we ignore the investment in the subsidiary of the parent because that's really a investment in itself once we've consolidated, so we just ignore that. Other assets we can just add together. That's 87,000, and we can do a quick sum. That's not a sum. So 87,000 in total assets. The equity shares, we need to show just the parent. So this is P only. And that's equity shareholders of the group. We ignore the subsidiary shareholders because that is totally the parent. Had there been a part ownership, then we would have to do an adjustment for the non-controlling interest of the subsidiary. But in this question, it's 100% ownership, so that's quite easy. Now, the retained earnings are the retained earnings at date of acquisition. So we've got 50,000 here from the parent, and that's it. We're not going to include the subsidiaries' retained earnings because those were earned before the acquisition took place. So it's just the parent. Now, be careful again, this is the consolidation at the date of acquisition. If we wait a year or so, hopefully these retained earnings will have increased, and then the parent will be liable to a proportion of those retained earnings. But as it stands, it's the date of acquisition, so it's just the parent, which means the equity is 70,000, and the liabilities, we just add those up. 17,000, and then these two add up. And we can see here that the net assets equals the assets equals the liabilities plus the equity, which is what we expect. These two should be the same. So just to confirm what we've done there, we've ignored the investment in the subsidiary of 20,000. The price paid by the parent was exactly the amount of the equity and retained earnings in the subsidiary at the date of acquisition. So we can ignore that. The other assets are just parent plus subsidiary. This is parent only. This is parent only because it's date of acquisition. As I said, once we have traded for a year as a group, or even any period as a group, these retained earnings will have changed, and then we can begin to add in the post-acquisition retained earnings of the subsidiary. But as it stands, it's just the retained earnings of the parent. So that comes to 70, and then the liabilities, we just add those together, parent plus subsidiary, those two added together gives us a total liabilities, i.e. this figure plus this figure, of 87,000, which is the same as the total assets, which was what we hope